Our next speaker is actually, he is our PhD from Columbia University, Executive Chief Economist, Frank Nothaft. Prior to CoreLogic, he's also been in various leadership positions with Freddie Mac, and also before that, he was on the board of governors of the Federal Reserve System in the mortgage and consumer finance division. Frank, are you there?
I am. Yes. Hi, Debbie. Thanks so much for having me today.
Hey, thank you. Can I also comment? Actually appreciate, I love your bow ties. So I even try to convince my dad, you have to dress up like Frank. So thank you so much for, encouraging us in different ways.
Absolutely. Glad to do it.
Thank you. All yours, Frank.
Okay, thanks. I've got some slides that I'll refer to. So let me just do a quick screen share. Okay, let's see. Let's start here. And you can all see that? Us economists, we love to talk about data and charts. So I've got a lot of charts.
We can see your screen. Thank you.
Excellent. Okay, good. So again, thanks for having me here at the conference. These are some of the main points that I'll cover in my remarks today. I'll talk a little bit about the overall demand for single-family homes, whether it's to buy or to rent, and that remains extremely strong. Strong here in the beginning of the year, but I think throughout 2021. We are expecting home sales this year to be the best since 2006, the best year for home sales in 15 years. That means I continue to expect that we'll continue to see some upward pressure on home prices. As you know, in the latest indexes, home prices are up double digit over the past year. I think we're going to see that trend continue in the next few months with some moderate slowing in price growth as we get toward the end of this year. But still a pretty strong year for price growth, and rents will probably be up too. I'll shift and share some thoughts on what we have seen, the impacts of the pandemic on the housing market. The pandemic has touched and affected each and every single one of us in our personal lives, in our work lives, and it's had impacts on the housing market as well. So I'll talk a bit about that. I'll just share some thoughts also on mortgage originations, what we see happening this year. It's going to be a great year for mortgage originations. It started off really strong. The volumes are going to be less than in 2020. 2020 hit the ball out of the park. We had the best year for mortgage originations since 2003 last year. So it's hard to keep up that pace. So I do think we'll see a little bit less volume here in 2021, but it's still going to be a really great year. This year will turn out to be a lot busier and more volume than 2019. And I think we all thought 2019 was a pretty good year. Well, this is going to be a much better year than that, just not as good as last year. So that's a summary, but let's first talk about housing demand. And what I've plotted here is the age distribution of the US population by single year of age as of 2020. And I've highlighted a certain portion of the millennial cohort. You can see the millennial cohort, those aged 28, 29, and 30 years of age last year in this cohort, those are really the biggest numbers of millennials. A few of them have already transitioned to home ownership, but for the most part, they haven't. And the median age of a first-time home buyer in the United States is 33 years of age. So as you can see, this year, next year, and a year after, we're going to have increasing numbers of millennials entering that prime age of first-time home ownership. And in fact, the record low level of mortgage rates that we have seen over the last several months has really been an invitation to millennials to step it up and to enter first-time home ownership. And that's exactly what they did. We saw large numbers of millennials step into the marketplace over the last 6 months of last year and transition into first-time home ownership. When we look at CoreLogic data on what's the distribution of loans by a cohort, we see a steady march where millennials represent an increasing portion of home purchase originations in each of the last several years. But last year in particular, millennials really stepped it up. You can see this trend line that I drew. The light blue bars represent the percent of home purchase loans that are made to millennials. Millennials are an increasing share of the home purchase market. And that's why that light blue bar is getting a little bit taller each year. Each year it's been growing about, 2 to 3 percentage points per year. In 2020, it jumped by 7 percentage points. Millennials represented the majority of home purchase loan originations last year. So they stepped it up. And I expect this trend where millennials represent the bulk of home purchase mortgage originations to continue this year and next, primarily because a large number of those millennials, those aged 28, 29, and 30, are entering those prime years of first-time home ownership. As you know, we've got a shortage of inventory on the market for sale. That's an important reason why home prices are up. Home prices are up because we got strong demand driven by low mortgage rates and large numbers of millennials looking to buy. Millennials looking to buy and Gen Xers looking to trade up. But we also have a limited inventory. Now, one way we can address that limited inventory is to build more homes. And we really do need to. And home builders have stepped it up and they've started to build more homes. And it's very interesting when we look at CoreLogic data to look at the number of new home sales, the number of new home settlements, and we look at it by month. It's dramatic how much of an increase we have seen in new home settlements. Now, there was a little hiccup last April and May because of the pandemic, the national emergency, and the shelter-in-place restrictions that we saw throughout much of the United States. And in April and May of last year, new home settlements fell, existing home sales fell as well. But what's been so interesting is the vibrancy of the home sales market, the vibrancy especially of the new home market, the new construction market. That's bounced back very strongly. And in each of the months over the last 6 months, 7 months of 2020, new home sales were up significantly relative to the same month a year earlier, pre-pandemic. And that trend has continued here in the early part of 2021. And it's interesting to look at where these new home settlements are. And again, that's helping to alleviate some of that inventory shortfall that we see in lots of local markets. When we take a look at CoreLogic data and we look at the biggest markets for new home sales in 2020, the biggest markets tend to be large metro areas, mostly in the South or out in the West. And topping the list, topping the list easily, has been the Dallas-Fort Worth metro area, followed by the Houston metro area. And they have topped the list of new home sales for the last 3 or 4 years straight. It's not surprising when you look at the migration patterns and the population shifts that we have seen in the United States over the last year, but also over the last 10 years. The big shifts in the population has been from the Northeast and the Midwest to the South and to the mountain states and out west. And in particular, in 2020, the state with the largest increase in population was Texas. And number 2 was Florida. Number 3 was Arizona. And when we look at the list of where the new single-family home construction is happening, where the biggest markets are, they tend to be in Texas, Florida, Arizona, and other markets in the South and out west. That's where the population has been migrating. That's where the population is shifting, and that's where the demand is. So it's important that we have this new construction to add to the inventory and meet that need for more housing. There's not enough existing housing, especially in those markets that are having strong population growth. Now, when we look at how the new homes are financed, what types of mortgages are taken out, what we see is that about 2/3 of the mortgages nationwide that finance new homes are conventional mortgages. About 1/3 are government programs like FHA and VA. But there's a great deal of variation in type of loan product based on the price of the home. So in those markets where homes are very expensive, where you have new homes are being sold and delivered at $1 million plus, nearly all the loans are jumbo loans. And if it's not a jumbo loan, it's a conventional conforming loan. There's almost no FHA, VA, whereas for lower priced homes, new homes, you'll see FHA and VA is roughly half the market. That's going to be in some of the smaller urban markets, maybe urban markets near where you have military bases, in some of the lower cost housing areas in the United States. I want to turn now and talk a little bit more about what we're seeing with home prices. I mentioned double-digit growth in home prices in our latest CoreLogic Home Price Index. And as I mentioned earlier, that's a reflection of strong demand driven by record low mortgage rates and millennials looking to be first-time buyers and Gen Xers looking to trade up. It's also driven by an inventory shortage, a shortage of existing homes for sale. And the result is that prices are up at a double-digit pace. When you compare them with the average annual price growth per year in the prior decade, prices are up double, more than double, what they had been on average per year in the prior decade. Now, our forecast is that home price growth will remain quite robust for the next few months and then gradually slow down. I don't see a home price drop in our national index, but I do see a moderation. And for 2022, we see home price growth moderating to about a 3% growth rate. So still pretty good. That's still a little bit faster than expected inflation, but we shouldn't expect to see double-digit home price growth year after year after year. Right now, it's understandable. There's a lack of inventory. But as we get to next year, I think we're going to see two things. One, we're going to see maybe mortgage rates a little higher. And with home prices up, that puts a squeeze on affordability. As a consequence, demand will just taper off a little bit. So we'll have a little bit less pressure from demand on prices. And secondly, we're going to see more inventory. We're going to see more inventory from two sources. First, home builders building more supply. And secondly, we're going to see it from existing home owners, especially older home owners who had wanted to sell their homes sooner, but decided to postpone it because we were in the midst of a pandemic and they were at higher health risk from the pandemic. I think by the time we get to the spring of 2022, most of the population will be vaccinated or will reach herd immunity, and the concerns about the pandemic hopefully will be in the history books. At that point, I expect to see an increase in listings, new listings of existing homes in spring of 2022, adding to the inventory, adding to the supply. So a little less demand, more inventory for sale. That leads to a moderation in price growth in 2022. One thing about this increase in home prices that we've seen, this double-digit home price growth, is the fact that it's created and built a great deal of home equity. So the average home equity increase per homeowner in the United States in 2020 was about $26,000, $300 on average per homeowner because of that double-digit home price growth that those homeowners saw during the course of 2020. Now, again, it's not evenly distributed. It's not an equal amount for every homeowner in the US. It varies a whole lot depending on where you live. Depends on how quickly home prices were rising And it depends on how expensive homes are where you live. So on the West Coast, where homes are expensive, we see larger price gain, larger home equity gains. In places where home prices are lower, we generally see smaller amounts of home equity gains. These home equity gains really provide an opportunity for homeowners to support their home improvement expenditures on their homes, especially for some of the bigger dollar home improvement expenditures, such as remodeling the entire kitchen, finishing off the basement, adding an extension to your house, adding an extension for your office from home, and perhaps for your classroom from home that you need for your kids. And that's what we've seen. We've seen home improvement spending increase over the last year to a record level, and we're expecting another 4% increase in home improvement spending here in 2021. As I mentioned earlier, the pandemic has really had a significant impact on demand for space, demand for residential space, demand for commercial space, and affected the decisions on where families want to locate. There have been a couple of surveys out there about how the pandemic could possibly affect the long-term demand for residential space. I'll just highlight the first bullet here, the McKinsey Global Institute study that concluded that in their view, more than 20% of the American workforce maybe could work remotely 3 to 5 days a week as effectively as they could if working from an office. And if that turns out to be true, that means about 3 to 4 times as many people working from home in the future compared to what it was pre-pandemic. That has really big implications for how much residential space, how much square foot of space a family wants in their home. And it has implications for the commercial sector, for the non-residential sector. How much office space per employee do companies need to have? And the severing of that relationship between the location of the employee and the location of the work or the office has been really important. If you do not need to be commuting into the office 5 days a week, if you only need to do it 1 day or 2 days a week, or maybe no days a week, then you can pick up and relocate, move to a place that's further away, where the cost of living is a lot cheaper, where the population density is a lot lower. And indeed, that's exactly what we have seen here in the United States over the past year. And when we look at home prices and rent changes by structure type, whether we look at single-family detached, single-family attached, or multifamily, a dramatic shift over the last 12 months. Single-family detached homes are in big demand by home buyers and by renters. On the other extreme, multifamily rental has been shunned in some sense. And when we look at price growth and rent growth, strongest price growth, strongest rent growth is with single-family detached. In multifamily rental, prices are down on average in the US, and rents are down, again, on average in the US. And when we look at some of these migration patterns, we took CoreLogic data to see where people were moving. And the red discs on this map show markets where there was net out migration of home buyers, and the blue discs represent in-migration of home buyers. And it's really interesting. Densely populated areas or high-cost markets are where we see some of the big red discs. People moving out of those areas, moving to places with lower population density and with a lower cost of living. I've got one last slide I'll share with you. And this is information we pull out of our loan servicing database, which covers about 3/4 of all the home mortgages in the United States. We took a look at the contract interest rate on home mortgages outstanding here at the start of this year. And what we found was that there was still about $3 trillion of home mortgages outstanding with a contract interest rate of 4% or higher. Now, for about 2/3 of those, I think there's some frictions that will prevent them or make it very difficult for them to come in and refinance. I show this because in my mind, at the start of this year, we still had a good potential for about $1 trillion of home mortgage debt to come in and refinance just to lower that interest rate. That's a lot of money still out there. Some of them have come in and refinanced over the last quarter. And I think we're going to see more of them over the course of the rest of this year. So we covered a lot of material. Thanks so much for your time. Debbie, happy to take any questions.
Sure. Thank you so much, Frank. I'm still actually looking, but I don't see any questions. But that doesn't mean that people won't pose questions. In case I come up with any other questions from our audience, I will send it over to you. So maybe you can take your time and then share with us. Thank you. Thanks again, Frank. Have a great rest of the day. Brad,
Thank you.
back to you.
Too.
Thank you. Thank you.